What's up, team? This is Ro, your best friend at JMSB. So here I was asked a question for COMM 305, Introduction to Managerial Accounting. Let's have a look.
So here it says, Nicole Limited is a company that produces machinery to customer orders using a normal job order cost system. It applies manufacturing overhead to production using a predetermined rate. This overhead rate is set at the beginning of each fiscal year by forecasting the year's overhead and relating it to the direct labor costs. The budget for 2020 was as follows. Direct labor, $1,810,000. Manufacturing overhead costs are budgeted at $905,000. At the end of the year, 2 jobs were incomplete. These were jobs 1768B with total direct labor charges of $111,000 and 1819C with total direct labor charges of $390,800. On these jobs, machine hours were 287 hours for the first job and 647 hours for the second job. The direct materials issued for the first job amounted to $229,000, and for the second, they were $420,200. Total charges to the manufacturing overhead control account for the year were $902,500, and direct labor charges made to all jobs amounted to $1,582,600, representing 247,800 direct labor hours. There were no beginning inventories. In addition to the ending work in process just described, the ending finished goods inventory showed a balance of $560,760. Sales for the year amounted to $6,205,300. Cost of goods sold totaled $3,644,940. And sales, general, and administrative expenses are $1,850,700. The above amounts for inventories and the cost of goods sold have not been adjusted for any over or under applied overhead to production. It is the company's practice to allocate any over or under applied overhead to inventories and to cost of goods sold. In Required 1, we're asked to calculate the amount of under or over applied overhead for the year 2020. In order to tackle Required 1, the very first step is going to be to use the budgeted information that's been offered here to establish a predetermined overhead application rate. So the first step is going to be to figure out at what rate is the firm applying manufacturing overhead costs to production. In order to do that, we're first going to figure out what our budgeted overhead is, which is offered right here, $905,000. We're also going to ask ourselves, what is the practical use of the cost driver? So here we're told that the cost driver is direct labor costs, and we're offered the budget for direct labor as well. So to calculate the application rate, the idea is to simply divide the two values. We're going to divide total budgeted MOH by the practical use of the cost driver, and that's how we're going to come up with our application rate. And so if we did that, in my opinion, you'd end up with a rate of 50 cents. And that's simply because the manufacturing overhead is budgeted at $905,000 and the practical use of labor costs is $1,810,000. So if we divide these two, we get an answer of 50 cents. What that essentially means is that every time we're spending $1 on labor for a given job, we're also going to be assigning 50 cents of overhead to that job. Once we've figured out the application rate, the next step is to determine the total amount of applied manufacturing overhead costs for the year. And the way that we do that is simply by multiplying this rate by the actual use of the cost driver. So the idea is to multiply 50 cents by the amount of labor costs that were actually incurred during the year. The predetermined rate multiplied by actual use of the cost driver. In this particular example, we're offered the amount of labor charges that were made to all jobs during the year. So we can see right here that it's $1,582,600. So if we were to simply multiply this by 50 cents, we'd be able to come up with the applied MOH for the year. And so if you did that, I'm hoping that you'd come up with an answer of $791,300. Now, once you've determined the amount of applied overhead for the year, the idea is to compare this value to the actual overhead for the year. And then you'd be able to determine if you've over-applied or under-applied MOH. In this particular example, we can see that the total charges to the manufacturing overhead control account amounted to $902,500. Since we applied a smaller amount, since we've only applied $791,300, it would be safe for us to argue that MOH has been underapplied during the time period. The amount of underapplied MOH is simply the difference between the actual overhead and the applied overhead. And if we were to work that out, I'm hoping you'd get an answer of $111,200. So there we have it. That's how I would tackle required 1. Let's have a look at required 2. In required 2, we're asked to prorate the amounts calculated in Part A to the ending balances of WIP, finished goods, and cost of goods sold. Now, this is typical of what the firm does whenever the amount of over or under applied MOH is assumed to be material. So whenever it's a significant amount, it's a big difference, rather than closing it off just to cost of goods sold, the firm is going to prorate the difference to work in process, finished goods, and to cost of goods sold. In order to tackle required 2, the very first thing I would recommend to do is to determine the ending balances for each of these accounts. What is pretty convenient in this example is that we're told what the ending balance is for our cost of goods sold. We're also offered the ending balance in finished goods. We simply have to calculate the ending balance for work in process inventory. So we can see that our cost of goods sold and finished goods are simply offered in the problem. The cost of goods sold is $3,644,940, and we can see that our finished goods are also offered. They happen to be $560,760. So that would be just the last statement or the last sentence of the third to last paragraph of the problem. What we also want to determine is the ending balance in our work in process inventory. In order to do that, we're going to have to add up all the product costs that are assigned to the 2 jobs that's remained work in process at the end. So we're told that these jobs have labor costs $111,000 and $398,800 respectively. So that information is offered here in the second paragraph of our problem. We're also offered direct material charges for each job. What we're not offered is the amount of overhead that has been applied to each of these jobs. The way that we're going to apply the overhead is simply by using the rate that we've calculated in required 1. We know that the application rate is 50 cents of overhead for every dollar that we spend on labor. So we can take the labor costs that are charged to each of these jobs, multiply them by 50 cents to determine the amount of applied manufacturing overhead. We can then add up the product cost for each job to determine the value of each job at the end. And if we add up these 2 totals, we're now going to be able to figure out the ending work in process. So since these are the only 2 jobs that remained work in process at the end of the time period, their total balance, $1,401,900, is going to be the ending balance in our work in process inventory account. Now that we know the ending balances for finished goods, work in process, and cost of goods sold, the next step is going to be to use these balances in order to determine the weights for each of these accounts. How do we calculate the weights for each? We're simply going to divide the ending balance of one of them by the ending balance of all 3 accounts added up. So for example, the weight for cost of goods sold would be the ending balance of cost of goods sold divided by the 3 ending balances added up. So we can see that cost of goods sold make up 65% of the total. We can apply the same logic to our finished goods and to our work in process inventory. So all that I'm doing here is I'm figuring out what percentage of the total does each individual account balance represent. Obviously, these weights are going to add up to 100%. And so if you work it out, you should be getting 0.65 for cost of goods sold, 0.1 for finished goods, and 0.25 for work in process inventory. Once you've figured out the weights, you're now able to assign or adjust the total amount of underapplied overhead to each of these accounts. So in required 1, we determined the total amount that was underapplied, and now we can sort of use these weights so that we prorate the amount to each individual account. For cost of goods sold, it's simply going to be 111,200 times 0.65. For finished goods, it would be 111,200 times 0.1. And for work in process inventory, it's going to be 111,200 times 0.25. And so that should be the answer for required 2. This is the amount of underapplied MOH that is going to need to be adjusted to each of these accounts. And I remind you that because we've underapplied overhead, we're going to be adding these amounts to the unadjusted balances for each. So there we have it. That's required 2. Let's look lower down and try to tackle required 3. It seems as though in required 3, we're asked to make an income statement for the firm for the year, and we're offered an income tax rate of 40%. Once we've calculated our cost of goods sold, using our cost of goods sold, the sales information, and our period expenses, it should be pretty straightforward to set up an income statement. I remind you that an income statement is always for a period of time, so the way that you write the date is kind of important. Rather than saying it's as at a particular moment in time, I'd rather you say that it's for a time period that is ended. So in this case, we're going to argue that it's for the year ended December 31st, 2020. The first line item on an income statement is always going to be sales. In this particular example, we're offered the dollar value of sales. We see that sales for the year are $6,205,300. As a word of caution, I want you guys to know that sometimes they offer you a markup percentage, and whenever that's the case, the markup percentage is always offered or added to the unadjusted cost of goods sold. So whenever they offer you a markup, the way you calculate sales is by multiplying the unadjusted cost of goods sold by 1 plus the markup percentage. In this example, it's easier because the value for sales is just offered. From our sales, we deduct or less the adjusted cost of goods sold. So in this example, we were offered our cost of goods sold, and we have prorated and required to the amount of underapplied MOH that should be added to this value. So if I add up those two values, I get my adjusted cost of goods sold. The disparity between your sales and your adjusted cost of goods sold is simply your gross profit or loss. From your gross profit or loss, you're now going to take away operating expenses or period expenses. In this case, the period expenses are selling, general, and admin, and we can see that they amount to $1,850,700. So I'm going to deduct the operating expenses, and now what's going to be left over is essentially our pre-tax income. From our pre-tax income, we're now going to deduct the taxes. We're offered a tax rate of 40%, so 40% of $637,380 should amount to $254,952. If we take the difference between our income before taxes and our income tax expense, then the balance is going to be our net income or net loss. So in this example, I'm getting a net income of $382,428. So that should be the final answer for required 3.
All right, valued members of Team Success, I really hope my explanation helped you guys. And if you have any friends that are taking managerial accounting, they're struggling with the course, you guys know what to do. Make sure you tag your friends and help us spread that love. In the meantime, guys, keep well, study well, row out.